So far, 2023 is turning out to be a pretty bullish year, at least for the first month. We have got the S&P 500 breaking above the mother of all trend lines that I mentioned in my last video, and more importantly, staying above that trend line, which means that likely it was not a false breakout. And we've got the 50 moving average crossing above the 150 moving average, which is a very powerful technical signal of a change in trend. So what can we expect for the rest of the year? So far, the S&P is up over 6% for the year. Now, history shows that when you get a very bullish January after a down year, the rest of the year tends to be very bullish as well. You know, going back to the 1950s, you can see that these were all the years when previous years were negative. And these years started with a very strong January of above 5%. So 1954, January closed above 5.1%. This was after a bearish previous year. 1961 was after a bearish year. It went up 6.3%. 1967, 7.8%. 1975, 12.3% after a disastrous 29% drop the previous year. 2019, after a 6% drop, it closed 7.9% for January. And for 2023, after a 19% drop last year, we are up 6.18%, which is about 6.2%, right? So based on history, although you can see it's a pretty small sample, right? But based on this sample of history, you can see that every single time this happened, the year ended pretty bullish. In fact, the average return of all these years was an average of 29% gain for the year and a median of 28.9%. So will we be up above 20% this year? I think there's a pretty high chance we may if this pattern repeats. At the same time, don't forget that this year is the third year of the US presidential cycle, which historically is the most bullish year of the 4-year presidential cycle. So let's take a look at this as well. So the US presidential cycle is made up of 4 years, which is the post-election year, the year after he gets elected, the year he starts being president. So Biden became president or started the first year as president in 2021. That's called post-election. 2022 was last year, which was the midterm elections. This year, we are in the pre-election year, year 3, which is 2023, and next year, 2024, would be election year, where Biden may win or lose re-election, right? Now, historically, since 1970, you can see that the most bearish of the 4 years have been, there you go, the midterm election years, which was last year. So that also added to the bearishness last year. But we are in pre-election year this year, and historically, this has been the most bullish of the 4 years. Historically, during pre-election years, the S&P 500 has closed an average of 16% up for the year. The Dow up 16% as well, and the Nasdaq up 28%. Could it repeat again this year? No one can know for sure, but again, we've got a pretty good probability. Now, some of you may be saying, but Adam, in previous years, you know, interest rates may have been much lower. Now interest rates are higher. The Fed is raising interest rates. In those times, the Fed was cutting rates. That's what I thought. Okay, but let's take a closer look at all the past third-year presidential years, right? Let's go back. Well, let's take a look. So these were all the year 3 of the US presidential cycle. We had 1971, 75, 79, 83, all the way to the last one, 2019. Okay, and you can see that all of them ended bullish, except 1 year, only 1 year ended bearish, which was 2015. So essentially 12 out of 13 of these year 3 years ended bullish. That's a 92% hit rate. That's pretty high, all right? Now again, what's interesting is if you look back at all these years, were interest rates lower than where they are now? No, they were all higher. So take a look at the 10-year yield during those years, the interest rate on a 10-year bond. In 1971, the 10-year yield was at 6.6%. In 1975, it was 8%. In 1979, it was 9.2%, and 1983, it was 11%. So not only was it high, it was going up. Interest rates were rising like crazy, but even then, the annual returns were all positive. And in fact, only in 1987 did interest rates start to fall, but still it was 8.6%, which was really high. And that still ended up 2%. Where are we today? As of now, the interest rate on the 10-year bond is only at 3.5%. So if you're telling me that, interest rates are high, they are going up, and so we can't be bullish, that's absolute crap, because it was higher and it was going up during all those previous years. Now, if you're not as bullish as me this year, I don't blame you, because the majority of people are very, very bearish. And the majority of people believe that we are going to go even lower this year, that we have not seen the bottom yet. So if you take a look at this article on Bloomberg that just came out, I think yesterday, stocks are poised to hit new lows this year based on a survey of investors. This was out 30th of January, which was about 2 days ago. And check this out. Roughly 70% of respondents in the survey say that the stock market has yet to hit bottom. The biggest weighting, 35% of them, says that the lows will not be in until the second half of this year. So they believe we're going to go lower. We're only going to bottom in the second half of this year. So this explains why most people are very upset now that the market keeps going up, because either they are short the market, 70% of them are short the market, or they have not bought into the market and they've sold everything last year and they're like, what the hell, why is the market keep going up, right? And the more the market goes up, the more pissed off they get, the more upset they get, because they are bearish. But one of the things that I learned many, many years ago is that don't fight the trend, right? And you can see clearly the trend is up, at least for now, right? Wave up, wave down, wave up, wave down, wave up. Now, nothing goes up in a straight line. Of course, we could always wave down again, but overall, the trend remains up, at least for now. So we've broken out of this mother of all trend lines. We've got a clear uptrend signal. What could go wrong? Well, a lot of experts are predicting that this bull market is going to get killed by the Fed today. So at 2 p.m. Eastern time, which is 3 a.m. Singapore time, the Fed is going to announce their next interest rate hike. So everyone is expecting them to raise interest rates by another 25 basis points. Now, if Fed Chair Powell comes out and says some crazy ass shit or is extremely hawkish, sure, that could kill this bull market, or that could cause the market to at least pull back significantly. So that's one thing that could, of course, screw up the bull market. You never know what he's going to say. The other thing that could, of course, derail this bull market would be if companies announce horrible earnings. Big tech announces horrible earnings. Today, Meta is announcing earnings. Tomorrow, we've got Alphabet, we've got Amazon, and we've got Apple. So it really depends on what earnings they announce. What's interesting is last week, Microsoft announced earnings that were worse than expected. They disappointed on revenue. Earnings were slightly a bit disappointing. But what's interesting is the stock price didn't go down, it went up. So you never know. So unless big tech announces horrendous earnings, the market should go up. But if it announces really terrible earnings, sure, it could kill the bull market as well. So you can see in the recent days, we've got all these prophet of dooms coming out. You've got Michael Burry saying one word, sell. Okay. You've got this guy, don't know his name, he's some black swan manager. He says the market is headed for a tinderbox time bomb that will be worse than 1929 crash. Oh my God, we're gonna die. We've got Morgan Stanley's Mike Wilson, who said, don't buy the rally as the Fed is looming. So almost everyone is saying that the Fed will kill the bull market, or corporate earnings will kill the bull market, it's gonna go lower, we're gonna die. And the only person who says it's gonna go up, besides me, right, is Jim Cramer. Jim Cramer says, we're in a bull market. And I said, oh, fuck. Okay, so this is the only thing that's worrying me. Because Jim Cramer It's a way of jinxing shit, right? Every time he says it's going to go up, it goes down. When he says it's going to go down, it goes up. Holy crap, Jim, why did you say it's going to go up? Why couldn't you be bearish like everyone else? But never mind, right? So anyway, so Michael Burry says, sell everything right now. So of course I couldn't resist and I had to type this in my Twitter feed that I said, buy. But in all seriousness, if you are an investor or you are a trader, who should you listen to? Should you listen to Michael Burry? Should you listen to Jim Cramer? Should you listen to Adam Khoo? Should you listen to that bearded doomsday prophet? Yeah, who should you listen to? And the right answer is, if you're a serious investor and you are a serious trader, you should listen to no one. That's right. And I'm here to tell you, frankly speaking, I don't listen to my own predictions because predictions are purely for entertainment. No one can predict the future. No one can predict the market. And if you base your investment and trading decisions on predictions, you're a dumbass. Okay? So all these predictions I make is really for entertainment. At the end of the day, as an investor, my investment decisions have nothing to do with my predictions. So whether the market goes up or it goes down in the short term, I don't really care. Because I invest in great companies that will always go up over time. So I expect the market to go up because I'm bullish. But here's the thing. If the market indeed goes lower this year, if it does, will I be happy? Yes, because it only means that I can get the chance to buy more shares of the high quality companies that I want to buy. So at the beginning of every year, I set aside a certain amount of cash to invest in the markets. Now, so far, I've set aside the cash. This year, I've not bought anything yet because the market kept going up. I only buy when the market's down. I only buy when I get a big discount to intrinsic value, when I get a margin of safety. So if the market doesn't go down this year and the market keeps going up and up and up, you know what? This year, I have nothing to buy. I've got nothing to buy. Okay? So if the market goes down, in a way, I'm happy because I can buy more shares, which will eventually go higher next year and the year after, and I'm going to make higher profits. So I'm going to be happy if the market goes down in the short term. But if the market goes up, I've got nothing to buy, but I'll look like a god because I was right. So I'll also be happy, right? So whether the market goes down or goes up, in a way, either way, I win as an investor. So you got to have that philosophy. Do not base your decisions on predictions. You just follow your investment plan and listen to all these predictions purely for entertainment purposes. How about for my short-term swing trading? So as you guys know, I'm a trader as well. I swing trade stocks and options. Again, it's got nothing to do with the market, right? So for example, just today, I've identified a trade that I'm going to enter. And this trade, I shared it on my Discord channel. By the way, a lot of you are asking me, you have to be a student in order to get into the Discord channel, right? So I've identified two potential trades that I may take today, depending on whether it meets my price. One of them is UNM, right? And another one is ADP. So let me talk about UNM as a potential trade setup just to make my point. So UNM, it meets one of my swing trading criterias, and it's what I call the breakout within base criteria. So you can see that this UNM stock, and again, this is just for short-term trading, right? It was on a clear uptrend, as you can see, and then it formed what I call a base, and it's breaking out of this base by breaking out of this level of resistance. So you can see over here, this is my intended buy order. So if the price goes up today, above the high of yesterday's candle, I'm going to enter a buy order at about $41, sorry, about 42.06 is my buy level here. Okay. Now at the same time, you can see that I will also have a preset stop loss at about $40.50. So whenever I take a trade, I risk a small percentage of my capital. 1%, that's it. 1% risk. I get in a trade with a stop loss, and I've got my profit target somewhere up there. So again, it has nothing to do with my predictions, right? So if the market goes down, what happens? It hits my stop loss, I lose 1%. That's it. If it goes up, hits my profit target, I'll get 2% or more. And in trading, I just have to be right half the time. Because when I'm wrong, I lose 1%. If I'm right, I make 2%. And I just keep trading this way. And that's how I just make that differential. Where I make more when I'm right, I lose less when I'm wrong. So the whole point of this video is to share with you that, as you read all these things in social media, as you read all these opinions in the media, people are bullish, people are bearish, no one can agree. I mean, think about it. If everyone thought the market was going up, nobody would sell and a market wouldn't exist. If everyone thought the market would go down, no one would buy and the market wouldn't exist. So for the market to exist, there must always be a difference in opinions. There must always be a difference between bulls and bears. Always, right? And sometimes he predicts right, sometimes I predict right. No one knows. So if you're basing your investment and trading decisions based on short-term predictions, you are not an investor or trader. You are really a gambler. So to be a true investor and true trader, the key is to stick to your investment plan and stick to your trading plan. So that regardless of whether the market goes up or down in the short term, you will always win in the end. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.